not necessarily the kind of story you want to have at the beginning of the year. After what we've gone through over the last several months, you're kind of hoping for, so we say, a delayed Christmas present in January, and we're not going to get that. So I think it's marginally negative, certainly for the perspective in Europe. I don't think it's going to be a huge factor for the markets. Domestically, in terms of the UK and continental Europe, I think they're going to be looking at other catalysts, hopefully positive ones, more necessarily than Apple.
So as we talk about the trade that's happening globally right now, there is a general sense of risk aversion. However, the U.S. over the course of the past year or more has held up relatively well compared to other markets. Yet now the U.S. is playing catch up to the downside. Does this create opportunities, that disjointing, if you will, in the U.S. versus the world? And where would those opportunities lie given that kind of a situation?
Well, absolutely. I mean, we had the big disconnect between the U.S. and the rest of the world through October 3rd, when you had the huge outperformance of the U.S. As you point out, a lot of that has reversed. At this point, where we think there's going to be opportunity, given the short-term moves in the market, actually is in developed market equities. We're neutral on a strategic view, but tactically overweight developed market equities right now. We do think things have gone too far. Of course, that's never to say that they can't go further on the downside, but we do think there's opportunity. Over the medium term, I think where we would be thinking about actually is more so emerging markets, because I think there you do see valuation opportunities. We know EM has underperformed significantly over the last year, even if a bit better more recently. But valuations there in absolute terms look attractive, whereas frankly for U.S. equities, multiples are near the long-run averages, so you can't call them cheap.
Dan, how important is the oil trade to what's happening in that developed market versus emerging market thesis? And is it going to be one of the big themes that you'll be watching in 2019?
Absolutely. But of course, the dilemma when you think about oil is there's a lot of double-sided coins, if you will. On one hand, if you think falling oil prices is an indication of slowing global growth, clearly that's negative as far as the markets are concerned. On the flip side, and I think for us this is going to be the more important factor, is the impact that has on inflation and on inflation expectations. Because the way the Fed is looking at the U.S. economy and inflation over the next year, even if we think about oil as a more short-term factor, it does drive inflation expectations. If falling oil prices keeps inflation expectations low, that gives the Fed some room to pause. And clearly it's been worries about the Fed, worries about rising interest rates. That's been a key factor in the sell-off that we've seen in U.S. equities. So if lower oil means less inflation, and that means a more cautious, more dovish Fed, that in the end should be more positive for equities.